In 1720, a Scottish economist named John Law convinced the French government to let him run an experiment. He'd transform France from the most indebted nation in Europe into the wealthiest. The mechanism was elegant. Replace metal currency with paper notes backed by Mississippi Company shares. Print more notes, buy more shares, share prices rise, print more notes against the higher values. For 18 months it worked. Fortunes were made daily. The word millionaire was invented to describe them. Then, in May 1720, someone tried to convert their notes to actual metal. Then another. Then thousands. Law tried everything, restricting conversions, mandating paper acceptance, arresting dissenters. None of it mattered. The notes weren't backed by anything real. By December, Law was fleeing France in disguise. People who'd been wealthy on Tuesday were destitute by Friday. You're not holding Mississippi Company shares. But since March 26, 2020, something structurally similar happened to your bank deposits. The Federal Reserve reduced bank reserve requirements to 0%, not 3%, not 1%. 0. Your bank is not required to keep any of your money. And most people have no idea this changed. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. I started pulling Federal Reserve documents in late 2023, not because I wanted to, but because the numbers in my retirement account didn't match what I thought steady contributions should produce. And I kept seeing references to March 2020, changes that nobody seemed to talk about. On March 15, 2020, the Federal Reserve Board reduced reserve requirement ratios to 0% effective March 26, 2020. This action eliminated reserve requirements for all depository institutions. Before March 26, 2020, banks operated under a tiered system. The reserve requirement exemption amount was $16.9 million, and the low reserve tranche amount was $127.5 million. Above the low reserve tranche, banks had to hold 10% reserves. If you deposited $10,000, the bank kept $1,000 and could lend out $9,000. After March 26, 2020, that 10% became 0. The bank keeps nothing. They can lend out all $10,000 immediately to anyone for anything. The official reason, moving to an ample reserves regime where reserve requirements don't play a significant role in monetary policy implementation. The change was meant to eliminate reserve requirements for thousands of depository institutions and help support lending to households and businesses during the pandemic. The unofficial implication, your deposits are no longer money the bank holds, they're money the bank uses. This isn't a conspiracy, it's explicitly documented Federal Reserve policy. The reserve requirement ratios remain at 0 as of 2025, and banks' reserve requirements remain 0. This isn't temporary pandemic policy, this is the system. Fractional reserve banking isn't new. Banks have never kept 100% of deposits in a vault. What's new is the fraction approaching 0. The reserve requirement regime goes back to the National Bank Act of 1863. In the 1930s, banks were required to hold 25% reserves. After World War II, that dropped to 20% for large banks, 12% for medium banks, 7% for small banks. By the 1990s, it settled at 10% above a certain threshold, 3% below it. Every decrease was presented as modernization, more efficient capital allocation, better credit access, economic stimulus, and each time the underlying math changed slightly. Then March 2020 arrived, not gradually phasing from 10% to 8% to 5%, straight to 0. The stated justification was pandemic emergency response, but the underlying reason was the Federal Open Market Committee's choice of monetary policy framework, of an ample reserve regime, which is not a short-term choice. Look at what happened in the second quarter of 2020. Extraordinary growth in insured deposits during the first and second quarters of 2020 caused the FDIC's Deposit Insurance Fund Reserve ratio to decline below the statutory minimum of 1.35% as of June 30th, 2020. Deposits flooded in, stimulus checks, mortgage, forbearance savings, business rescue loans, but the insurance fund couldn't keep pace. In September 2020, the FDIC Board of Directors adopted a restoration plan to restore the reserve ratio to at least 1.35% within 8 years. The system had more claims on deposits than coverage for those deposits, and rather than require banks to hold more, the Fed required them to hold nothing. Here's where the math gets uncomfortable. Prior to March 2020, if you deposited $100,000, your bank kept $10,000 and lent out $90,000. The borrower spends that $90,000, which someone else deposits. That second bank keeps $9,000 and lends out $81,000. Eventually, your original $100,000 deposit creates roughly $1 million in total money supply through this multiplier effect. That's how fractional reserve banking has worked for decades. After March 2020, there's no fraction. Your bank lends out the full $100,000. The borrower spends it, gets deposited elsewhere, gets lent out again in full. Your $100,000 deposit can theoretically create infinite money supply. The only constraints are capital adequacy ratios, rules about how much equity banks must hold relative to assets, and borrower demand for loans. This matters because capital adequacy ratios measure bank solvency, not deposit safety. A bank can be well capitalized according to regulatory standards and still have zero actual cash to honor withdrawals. The system functioned on an implicit assumption: not everyone withdraws at once. In normal times, deposit inflows and outflows roughly balance. Banks manage daily liquidity through overnight borrowing from other banks or the Federal Reserve. It works until it doesn't. March 2023 demonstrated what doesn't work looks like. Silicon Valley Bank held $212 billion in total deposits. An abnormally large percentage were uninsured deposits, those above the FDIC limit. When depositors started withdrawing, SVB didn't have reserves. They had to sell long-term bonds at a loss to raise cash. That crystallized unrealized losses. News spread. More withdrawals. Within 48 hours, the bank failed. The government stepped in with emergency measures to protect uninsured depositors. Following the closures of Silicon Valley Bank and Signature Bank, the FDIC adopted a special assessment to recover the loss to the Deposit Insurance Fund associated with protecting uninsured depositors after the systemic risk determination announced on March 12, 2023. But the underlying structure didn't change. Banks still hold zero required reserves. Every time reserve requirements have dropped significantly, two patterns emerge. Pattern 1. Credit expands rapidly. More lending, more borrowing, asset prices rise. This is presented as economic growth. And for a while it functions that way. Businesses borrow to expand. Consumers borrow to buy homes. Markets rise on increased liquidity. Pattern 2. Eventually someone can't pay back the loans, or interest rates rise and bond portfolios show losses, or depositors need actual cash and there isn't any. The structure collapses faster than it built up because the leverage works both ways. 2008 wasn't a reserve requirement crisis. It was a credit quality crisis. But look at who won and who lost when things unraveled. Who won? People who held actual cash or equivalents when panic hit. Institutions with access to Federal Reserve liquidity facilities. Banks that could borrow short-term at near zero rates and buy distressed assets. Investors who understood the system's mechanics and positioned accordingly. Who lost? People who assumed their deposits were safe because they were in a bank. Small businesses that couldn't access emergency credit. Homeowners whose property values collapsed but whose mortgages didn't. Anyone following the standard advice to keep 3 to 6 months' expenses in a savings account and max out retirement contributions. The advice wasn't wrong. The system changed, and changing the reserve requirement to 0 is the most fundamental system change possible. It removes the last mechanical constraint on how much money banks can create from your deposits. The FDIC still insures deposits up to $250,000 per depositor, per bank, for each account ownership category. That hasn't changed. Since 1934, no depositor has lost a penny of their FDIC-insured funds. But look at the insurance fund's mechanics. As of December 31st, 2024, the DIF reserve ratio was 1.28%. The FDIC projects that the reserve ratio remains on track to reach the statutory minimum of 1.35% by the end of 2025, 5 years after dropping below the minimum. The fund holds 1.28% reserves against insured deposits. Banks hold 0% reserves against your actual deposits. The insurance exists. The insured money doesn't. This only works if failures remain isolated. One bank fails, the FDIC covers deposits, no systemic panic. But if multiple banks fail simultaneously, which is more likely when they all operate under the same zero reserve structure, the insurance fund can't cover everything at once without Treasury backing. That's not speculation. In the week ending March 15th, 2023, the 25 largest domestically chartered commercial banks in the United States gained $120.2 billion in deposits, while smaller domestically chartered commercial banks in the United States lost $184.6 billion in deposits. People moved money to bigger banks they perceived as safer. The flight wasn't from banking. It was from perceived risk within banking. That's only possible because deposits can move electronically at scale. The reserve requirement regime was designed for a world where bank runs took days, lines of people demanding physical cash, time for regulators to intervene. That world doesn't exist anymore. Digital transfers happen in seconds. And when banks hold zero reserves, there's nothing to slow the panic. Your bank doesn't keep your money. The FDIC insures your deposits. Those are both true, but they're true in a structurally different way than they were before March 26th, 2020. I'm not telling you to withdraw your money. I'm not saying banks will fail. I'm saying the mechanical relationship between your deposits and actual reserves changed fundamentally, and most people don't know it changed at all. The advice didn't change. Put money in savings. Max out your 401k. Diversify. But the system those actions interact with is different, and doing everything right in a system that no longer functions the way you think it does produces different outcomes than you expect. I'll keep tracking this, I'll keep pulling the Federal Reserve documents, and I'll keep documenting when structural mechanics change underneath standard financial advice. If that's useful, subscribe.